Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Paul Sweeney, along with Tom Keene. Join us each day for insight from the best in economics, geopolitics, finance, and investment. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show. Weekday mornings from 7 to 10 Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen. And as always, on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Neil Grossman, co-founder, former CIO, founder, TKNG Capital, joins us here in studio. He's also owns a vineyard. Where's your vineyard, Neil?
It's in the Millbrook area, upstate New York.
Upstate New York, beautiful.
Hudson Valley, beautiful.
He always comes in bearing a bottle of wine. We appreciate that.
It's not open, I should add. It's early.
That's always
not yet.
Now, Carol Master and Tim Stenovic, occasionally in their afternoon Bloomberg Business Weeks, I'll see bottles open in their studio.
I can attest to that.
That's how they play.
It adds a clarity to the way you do analysis.
It does. Hey, Neil, we had a bunch of economic data. We just got through an earnings season. What's your view of the world here? I mean, we've got a market selling off a little bit today, but I mean, we've got a market that's S&P 500 up double digits, yields coming in. What do you make of this world we're in?
I'm more on this feels bubblish a little bit. I mean, let's take a look at Apple. I mean, wonderful company, don't get me wrong, but somebody added $300 to $400 billion in value on an announcement that they're going into something. I mean, it's pretty staggering when you think about it. I think when you watch the internals a little bit, the size of the moves of stocks based on a little miss, a little hit, or a little expectation, I don't remember stuff like this very much in the 40 years I've been doing this.
Paul, referring to the Fed meeting this week, and I wonder how you're processing what we heard from the Fed chair, what we saw in the dot plot and the SEP. How are you navigating those data points, and how's that sort of shaping your perspective on the market?
I'm a little lighter than normal right now, I would say. There was one thing I actually heard in Powell's statement, which, is something I think we have even talked about. He made the comment that the annualization of inflation data is going to be very hard to continue to see improvement. I think we're in a range of, let's say, 3.25% to 4.5%. Number one. Number
inflation?
Two, inflation.
Wow.
I'm looking. I use CPI. The PCE and some of the other stuff the Fed uses, to me, is a slice, and I understand somewhat why they like to eliminate a little bit of the volatility of things. But I think the discussions in the large of why people don't feel good is it's the bigger numbers that affect them, and there are a lot of really interesting things. I mean, the cost of insuring things, as you know, the cost of buying cars, some of the food costs, they're pretty staggering. And for the average person, airfares, hotels are off the charts. And so, the concept that maybe you're getting a little bit of a slowing in the rate of growth of inflation. Remember, we're still at 3 to 4, 5%, wherever it is, 3.6. I think people are feeling it still, and I think that's one of the issues. I did want to mention something which I've been thinking about. I mean, there's been a lot of talk for the last 2 years, basically, about the inverted yield curve and why it has not lived up to the expectations as an indicator of bad things to come. And I've been spending a lot of time thinking about this. The idea may well be that the inverted yield curve, given the structure of the economy now, is actually stimulative more than not. There are areas of the economy, obviously like real estate, where it hurts. But if you think about it, long-term yields are still relatively low, and corporate America, if it wants to borrow using a 4% base with very tight spreads, long-term borrowing costs are lower. So that's not a negative. Short-term money for the average investor is throwing off tons of yield. But on the other side, the real cost of money, the large borrowing, is coming out of the government of the United States. So they're borrowing at staggering quantities. They're short funding it, and then they're taking that money and it's running through the economy. So I think there are some interesting dynamics which have helped to support the economy a bit. We'll see as it goes right now, but
a lot of folks, Neil, are saying that this Fed is already behind the curve, that they should be cutting now. Are you in that camp?
Well, you know I'm not in that camp. Look, number one, they again, there's an asymmetry to what they do. One piece of data that looks good, and they've trained the markets to go crazy. Yeah. 6 months. I mean, we're 6 months or a year from where we were. The economy hasn't slowed. This argument. I know you had Bill Dudley on, who's an old friend of mine, talking about the neutral rate of interest rates, and wherever that falls, and again, I think this goes back to some of the other questions. Central bankers, and as you know, I was one for a while, tend to look at the liability side of the economy. They've never really, in my view, fully incorporated the asset side. And I think we are in an asset positive environment. So, and every time the Fed opens its mouth or the market seems to get its expectations up, what happens? Yields, how far have yields fallen in the last couple of days? We're 100 basis points lower in long-term yields in over a year. The dollar starts to weaken. Stocks are throwing off value, and so every time you liquefy, it works against the idea that you're going to get this sort of significant improvement in inflation. So I think we're going to be waiting. The last point is, and I know everyone's talking about September. I think Powell went off on a tangent last year because he was hoping he could get something done before the election. I do not know, unless you get a significant downgrading in this economy, how or a staggering drop in prices, which I don't see. I don't know how in front of this election, given the polarization, that the Fed really, and I know that this is not a political argument per se, but the meeting immediately before a major, maybe one of the most important elections, for them to be doing that, I think is going to be a very difficult thing.
All right, Neil, thanks so much for joining us in studio. Neil Grossman, he is a co-founder, former CIO of TKNG Capital, giving us some thoughts on these markets, on this Federal Reserve. He is a Fed hawk. Let's just be plain and simple here. I try to tee him up to kind of soften it up a little bit. Nothing happening. Tech stocks continue to be the story. I mean, I love when my tech stocks are leading the market. I feel like that's all we've known for the last 10 or 15 years.
This is your bailiwick. This is
it.
your
I'm
thing.
all in.
Yes.
But I get a little nervous when, that's kind of it. There's not that breadth you like to see in the market. But let's talk to a person who's kind of an expert in this stuff. Melissa Otto, head of TMT Research at Visible Alpha. Melissa, what's your tech call these days? Are you comfortable with where these companies are, with where their multiples are, with where their earnings are? How do you think about it?
Thank you. It's a really interesting time right now for the tech stocks. I think what we're seeing is that essentially GARP is kind of worked.
That's growth at a reasonable price for those of us old enough to remember that.
Taking out my pencil.
Yeah,
that's right.
So, stocks that are trading at, say, 20 to 30 times are actually generating decent growth. So when you think about the multiple that they're generating, or the ratio from that, it looks pretty reasonable. So it doesn't seem like it's out of proportion. Just coming out of the WWDC this week, Apple trades at a range of 27 to, say, 32 times based on forward-looking estimates. And I think what we've observed is that, based on Visible Alpha consensus, there is a trajectory getting essentially built into the market that is looking like there could be a really compelling replacement cycle, which I think, essentially took Apple up this week. Yeah. So I think when you think about where the growth trajectory is going and where AI is potentially taking it, the landscape looks really interesting.
That's where I want to go. So you mentioned that Apple Worldwide Developers Conference and the deal that it brokered with OpenAI, and we talk a lot about OpenAI. We talk a lot about NVIDIA as well. So these are the two kind of marquee names. I'm curious sort of how you see that landscape shifting and evening out. So there's so much obvious promise and faith in NVIDIA, for instance. When do we begin to see that sort of trickle down, and sort of what does it look like one level beneath NVIDIA?
NVIDIA is definitely
the lodestar.
Holy mackerel.
Yeah.
Based on Visible Alpha consensus, we see in the data, this year, the data center revenues are expected to generate over $100 billion. But looking forward several years, it's going to over 200. $100 billion in revenue growth for one segment is expected in the market. That is astonishing growth. And so, I think when we look at that, it just tells us, wow, there's something interesting coming down the pike, right? And so I think, for Apple, they're sort of the consumer end of that. They're the end user of that. What NVIDIA does is they're essentially building the infrastructure that's enabling all of this generative AI to even happen, to make it so that, users like you and I and organizations can actually have the compute power to do the generative AI things that are so productive and interesting.
So NVIDIA, obviously, I think for most lay people, that is their AI play, even though there's a lot more. On the software side, I hear Microsoft mentioned as a way, if you want exposure to kind of the next wave of technology, whether it's AI or whatever, I called it big data 2 years ago, now it's AI. Microsoft is a story. How do you think about that?
I mean, Microsoft is another monster. And based on Visible Alpha consensus, their Azure cloud business is expected to go from $75 billion and then over the next couple of years to $150 billion. I mean, so between NVIDIA and Microsoft together, you're talking about $175 billion in expected new revenue growth. That's incredible.
We had this news this week, Bloomberg reporting that two regulators are looking into Microsoft and NVIDIA when it comes to AI. And I wonder sort of what that tells you, not necessarily about those cases as they might be unfolding, but about where we are in this cycle. Again, we talk about the promise of AI, yet things are moving so quickly. You talk about doubling revenue. It's insane, like in the speed that you're talking about. But then you have news like this, and you wonder sort of what are the things that might slow this down or might bring this to a more normal pace? Is that even likely to happen, do you think?
I mean, it's a question that keeps me up at night.
Yeah.
I'm like, what happens if the consumer just doesn't adopt?
If it doesn't click.
Generative AI idea, it doesn't click. Because I really remember covering Apple back in the day, pre-iPhone, and I remember a lot of us in the investment community debating, is this thing going to take off? Are people going to like these touch screens? Or like there's no keypad? What about the flip phone? Remember those days?
Yes.
And I remember there were two really distinct moments when I thought, okay, this thing's going to be huge. The first was when I saw my 1-year-old child taking her finger on an iPad and very intuitively
it is very wild how that happens.
Engaging with this. Couldn't walk or talk really, but can engage with an iPad. I was like, wow, this is really interesting. Wow, this could create a whole generation of users that are not really baked into expectations. And the second was my mom, a widow and retiree, saying, I think I want to, convert from a flip phone to an iPhone. What do you think? Should I do it? And then it really revolutionizing her life. Things like GPS, text, the way she engages with us and her friends, really making her life a lot more fun and easy. And so if generative AI is able to do that, I think it could be really interesting.
Melissa, 30 seconds left. Amazon. What's your takeaway from Amazon?
Amazon is in a really interesting position right now. I was just actually at the Amazon AWS Financial Services Symposium. There was a lot of discussion around how generative AI is being brought into organizations. And I think the big takeaway from that is that, it's really going to move more to the cloud. Mm-hmm. And companies are really feeling that FOMO trade. And so when I look at the Amazon expectations for the AWS business, we have seen the Visible Alpha consensus numbers for AWS margin go up 120 basis points into Q2. So I think there's some interesting momentum coming in there.
Melissa, thank you so much for joining us. Melissa Otto, she's head of TMT Research at Visible Alpha, getting a little tech discussion this morning. David, you're a worldly guy. Let's talk U.S. sanctions. Let's talk U.S. industrial policy, U.S. protectionism, U.S. monetary policy. Are these good? Are they bad? Are they working? Are they not working? I have no idea. I did pay attention when I was at Duke to some of my economics classes, but I just don't know. Steve Hanke knows. He's a professor at Johns Hopkins University. Steve, thanks so much for joining us here. This is an election year, and we're starting to hear a lot more discussion about global industrial policy, U.S. industrial policy. Let's just start with, tariffs. Are tariffs good? Are tariffs / protectionism, are they good? Are they needed, say, for the electrical vehicle market? What do you think?
I think they're terrible.
Oh, boy.
And we just keep getting all the major political players in the game doubling down and proposing even more nutty tariff ideas with each passing day. We had Trump yesterday. He's got some idea. He's going to replace the income tax with revenues from tariffs.
Do we get we don't get revenues from tariffs, do we?
Well, we do get revenues from tariffs, but the revenues are actually a tax that come out of the hide of American consumers and businesses. So that's the tariff thing is really unbelievable because it's part of a larger picture, and sanctions are actually a form of protectionism. This is all really, David, under the umbrella of protectionism. So you have sanctions, and since 2000, the United States has increased the number of sanctions that we put on various individuals and countries by 900%. But it's amazing because scholarly literature shows us that these things don't work. They always end up backfiring, creating a lot of unintended consequences, and the sanctioned countries and individuals always find workarounds one way or another to get out of them. But in the end, when I say they don't work, they usually create what's called a rally around the flag effect that keeps the targeted leaders or elites in countries in the saddle. Vali Nasser, one of my colleagues at Johns Hopkins, an experienced diplomat, Iranian of origin, just did a big study with 3 other colleagues on Iran, and basically the sanctions we put on Iran have really created this rally around the flag effect, because the idea was the U.S. thought, well, we'll put the sanctions on, that'll put a lot of pressure on the middle class, and the middle class in Iran will come to our side. Well, no, the middle class either went to the sidelines or went on the side of the regime because they view those who impose sanctions on them as enemies.
Steve, let me ask you a little bit more about that. And I think it's a rare day when I don't see in my inbox a message from the Treasury Department about a new sanction, particularly with regard to Russia's invasion of Ukraine. And so we have the G7 meetings unfolding now in Italy, and Treasury Secretary Janet Yellen announcing a new raft of sanctions against Russia, I think tied to semiconductors. But you're getting at something I wanted to ask you about, and that is this kind of recent history of the weaponization of sanctions, the Treasury Department, the administration, this and previous ones really relying on them as a tool. I mean, Janet Yellen not shy about saying she thinks these are effective. You talk about Iran. As we pivot to Russia, are they any more effective when there is an actual military war, when you see the kind of ratcheting up that we've seen here in recent years?
The answer is no. If you read all of the scholarly literature, tells exactly the same story, starting in World War I, and that's these almost never achieve their desired objectives. And let me give you one. Let's go back to the 1970s. When the Soviets invaded Afghanistan in 1979. Jimmy Carter was in the White House, of course, and Brzezinski was the national security advisor, and they put a ban on agricultural exports from the U.S. to the Soviet Union. And what happened is what Bob Mundell called the Afghan effect, and that is the Soviets went to Argentina right away and cut a deal for grain. U.S. farmers, of course, were prohibited from sending and exporting grain to the Soviet Union. So the Argentines made out like bandits. The Soviets weren't hurt at all. And ironically, who was in power in Argentina at the time? Well, Junta was in power. They were supposedly the bad guys. So this is the kind of law of unintended consequences, this Afghan kind of effect.
I guess we're seeing that now with China. You see that relationship between Russia and China has grown in warmth, shall we say, since the start of that war.
Oh, yeah, absolutely. They're locked at the hip. And it's because of these sanctions, and now we put even further batch of sanctions on, as you indicated, with the G7. So it's just something that doesn't work. But the problem is it's part of this protectionist thing. The public thinks somehow they work. They have the impression that they work, and they become familiar with, they think, sanctions and comfortable with sanctions. So if we're sanctioning somebody, why not put a quota on them or a tariff on them? So you get out into a broader sphere of other kinds of government intervention.
And Steve, David brought up China. I'd love to get your view here, because I think there's a founded concern on many Americans' view about China, whether it's a technology Cold War between China and the West. We're concerned about TikTok being so pervasive here in the U.S. What do you think the U.S. policy should be about China in terms of trade and just overall relations there? Because there are some significant, I would say, meaningful concerns.
Well, we have a lot of the S&P 500 companies that are very involved in China and deriving considerable profits from China. And as far as I'm concerned, that's a good idea. Trade is always good. Once you start cutting trade off, you increase the chance that you're going to get into a hot war of some sort. And with the current administration, and this started, of course, with Trump and the former administration, we've essentially continued to escalate really what is an open commercial trade war with China, which I think is a very bad policy.
Steve, you mentioned Argentina a moment ago. Maybe I can ask you about what's been going on there lastly. So we were talking about Argentina in the 70s. How about Argentina today? And you have President Milei pushing really hard for this legislation that would make pretty radical changes and cuts to the Argentine economy, as he, I think, is going to Italy to meet with the IMF to try to renegotiate some of that country's debt once again. But we've seen the protests in the street. At the same time, we've seen Parliament in Argentina pass a kind of lighter version of that omnibus bill that was designed to kind of rework the economy there. What's your read on that as you look to that part of the world? Do you see him as making progress despite it all? What's your sense of what Juan Milei is doing in Argentina? Javier Milei is doing?
The passage 2 days ago of that omnibus bill was a big win for Milei. Mm-hmm. It was a squeaker. He barely got passed, but that's a good policy move and a good thing for Milei. His problem is, and his Achilles heel, is that he hasn't delivered on dollarization and getting rid of the central bank. And he campaigned on that promise. He hasn't done it. And as a result, they're really not getting inflation under control, and the peso just keeps sliding. And I think this will make him extremely vulnerable as time passes. He's quite popular right now. If you look at the polls, he's doing pretty well, and the passage of this bill by the Senate 2 days ago certainly was a help. But I think without dollarization, I think the story is going to be pretty much over in Argentina.
All right, Steve.
They have a long history of just not being able to do it. As long as they have that central bank there, it's like a recovering alcoholic with a bottle of whiskey in front of him.
All right. Hey, Steve, thanks so much for joining us. Always appreciate getting your informed thoughts. Steve Hanke, professor of Johns Hopkins University, and of course a proud graduate of the University of Colorado at Boulder, the Buffs.
All right.
Let's go Buffs. How about that? I used to live in North Jersey, and right across the street was the Short Hills Mall, which is just
famous.
It is just, it was packed. It's packed all the time. I mean, and people were talking about the death of malls. I'm like, not where I look. I mean, I would never set foot in there, but everybody else in the tri-state area
preempted me.
does. Yeah. But I mean, I don't know how to think about this, the whole retail business. Now everybody's kind of shopping online. I don't know how this whole thing works. Anjee Solanki, she knows how this stuff works. National Director of Retail Services for the U.S. for Colliers. Anjee, give us a state here. Now that we're, thankfully on the backside of this pandemic, and maybe consumers are getting back to normal behavior, if you will. Talk to us about how, the balance between, having the bricks and mortar store kind of works with the e-commerce side of the retail equation. How are retailers making that balance these days?
Oh, it's a great question, and thanks for having me. Honestly, it's really working well. They're really both integrated. So retailers right now have invested quite a bit of money over the past, call it 10 years, as it relates to the infrastructure for online. So they really are harmonious. We're seeing, online sales from most retailers, roughly around 18 to 20% is online, whereas in store still is the dominant place to sell. People still want to touch, feel, smell, and be educated. So I think, brick and mortar is far from being completely, forgotten.
When you look at how retail is navigating this macroeconomic moment, what are companies prioritizing? I know there was this push for expansion. Has that been scaled back? So how are they thinking about growing that footprint in the way that you're describing, both with brick and mortar and online as well?
Definitely. There is definitely still a high demand as it relates to, site expansion and growth. As you look at the very mature brands that are out there that have been quite successful year over year, they're continuing to look at the U.S. as a great opportunity for more sites. And, in speaking to a lot of these brands, they're looking at not just 50 locations, some are looking at 100 per year. And so when we're seeing that, and most of those segments are going to be your junior boxes, your big box type tenants, your grocery, those are, call it more mainstay, staple, sectors within our industry. And therefore, we're really going to continue to see that. What the challenge is that we have a lack of supply. The lack of supply is really what's hurting us because there hasn't been, call it new construction, and a growth in new construction throughout the U.S.
So I guess on the other side of the equation, how is the consumer doing? What are the retailers telling you about what the consumer's buying, how they're buying, how much promotion they need to buy? What are you seeing out there these days?
Yeah, it's been a really interesting kind of a little bit of a mixed bag. We are seeing a bit of a gradual slowing. We anticipate that when we forecast for the end of the year, that will still be slightly up compared to last year. However, we are going to see a gradual slowdown. Now, the areas that we're going to see a slowdown, we're going to see some slowdown, of course, in high luxury spend. We are still continuing to see a good spend in the discount category, but people are really paying attention to where they're placing their dollars. So even though we're seeing, spend occur in, the health and personal care, we're starting to see a bit of a slowdown in, call it, beverage spend, F&B spend. Prices have increased in that sector purely because wages have increased. I think the overall wage increase has been roughly, about 4%. So people still are making a healthy or decent amount of money, but they are being very cautious on where and how. But we are seeing one interesting thing, and that is in the entertainment sector. So people still want to have that joy and that experience. So when we stop and think about the concerts, there's been plenty of concerts that have been going on, but the cost of a concert versus the cost of going to either, whether it's just going out for a small dinner with friends or to see a movie, even though the movie industry, is the cinema industry is still softly kind of treading here. People still want to have this kind of entertainment experience.
I want to ask you about where you're seeing growth, and I'll confess I read a few of your notes before coming in here today, and Paul, at least having some fun talking about Brooklyn, but you highlight the fact that Fifth Avenue in my neighborhood in Park Slope, Brooklyn, one of the great retail stretches now in the country, which makes me so happy. And part of that are these kind of boba tea shops that are set up and constantly packed with young people. My daughter, this is a big deal now. So talk a bit about, you don't have to talk about that stretch in my neighborhood, but where we're seeing growth in retail, both in terms of geography and also sort of where there's opportunity in food, in beverage, that's a little different from what we've seen before.
Yeah, it's been really fascinating on the beverage side. So I think, what people are starting to realize, and of course, it's the younger generation, that, alcohol doesn't have to be the beverage of choice. And so we're starting to see these very diverse type uses start to expand throughout the U.S. And it's very interesting to see kind of that culture around it. So boba tea is one. We actually were working with a group called Swig. And if you look at Swig, and I think one of, there was a tagline, dirty sodas. Well, you stop and think about it, it's really a soda mixed with whether it's lemonade or a different type of juice, or different types of, add-ons. And it's really become a great way of kind of, introducing something unique and different, but enjoying it with your friends and socializing about it. So the trends that we're seeing in the beverage side have been, really embraced by the younger generation, and I don't see a slowdown. So whether Starbucks is selling boba teas now, and it's been one of their stronger segments within the product business. So is it a fad? Is it a trend? I think it's probably going to stay if we continue to see this cultural diversity. So we're going to see more of that. So stay tuned. I'm really interested to see what's happening there.
Anjee, the next question is for Lisa Mateo. How is luxury doing?
Yes. It's so fascinating. I'm going to bring it right back to New York for a moment. But look, LVMH, they're going to take down their building on 57th and rebuild. There's this definitely a gradual slowdown in terms of spend, but you have to kind of look at that number based on they had such a significant uptick, during the pandemic and shortly thereafter. So when we say, a gradual slowdown in luxury, they're still, still up compared to pre-COVID numbers. Look, luxury still, they're expanding, they're buying buildings or, their own real estate. They want to own their kind of longevity and where they're going to be for, the next, call it 30 years versus trying to negotiate and renew. Right. They just have to negotiate with themselves. So we're going to continue to see, that market be strategic in placement and where they expand.
All right, Anjee, thank you so much for joining us. Always appreciate getting your perspectives there on all things on the retail space there. Anjee Solanki, National Director of Retail Services for the U.S. firm is Colliers. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, geopolitics, finance, and investment. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show. Weekday mornings from 7 to 10 Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen. And as always, on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.